So good morning, good afternoon to everybody on today's call. My name is Jim McDonald with Torrey Hills Capital. Pleased to be hosting today's call featuring Gold Royalty Corp, a royalty company with a North American focused portfolio of more than 240 royalties and streams, anchored by a 3% NSR royalty on Odyssey, the underground portion of the Canadian Malartic Mine, Canada's largest gold mine. Company trades on the New York Stock Exchange under the ticker symbol GROY, as you can see on the screen there. And joining me today from the company, I've got David Garofalo, the president and CEO, Peter Behncke, corporate development and investor relations, and Jackie Przybylowski, capital markets. Before turning the call over to David, Peter, and Jackie, just want to go through logistics fairly quickly. Nothing new here for people who have been on calls with me in the past, but just a quick reminder. Our webinars are intended to replicate our in-person meetings, which we like and encourage to be as interactive as possible. With that in mind, if you have questions along the way, please feel free to ask them. The best way to do so is to use the navigation pane at the bottom of the screen, click on the Q&A or the chat button. We will see that, get those questions answered for you. If for some reason we don't get to your questions immediately, it's not that we don't see them or are ignoring them. It's simply that we know that we'll get to those questions in the next one or two slides, and so we'll let the normal course of the presentation answer those for you. Alternatively, if you'd like to speak with anybody during today's call, we encourage that as well. The only way to do that is, again, use the navigation pane on the bottom of the screen, click on the raise hand button. We will see that, be able to unmute your microphone and allow for direct conversation back and forth. As with all the calls, I will remain on throughout, but will minimize myself and take myself off of both video and audio so as not to be a distraction. But you're in for a good story here on Gold Royalty. And let me turn the hands over to David, Peter, and Jackie.
Well, good morning and good afternoon, everybody. Thanks so much for joining us today. Peter's going to bring up our slide presentation, but while he's doing that, I thought I'd just introduce myself. I'm David Garofalo. I'm chairman and CEO and founder of Gold Royalty Corp. We brought it public in March of 2021, and since then have assembled a collection of assets, a large portfolio and diverse portfolio of assets across the Americas, and most recently we've added a copper project in Bosnia as well to continue to diversify the portfolio. By background, I've spent over almost 35 years in the business. Most recently, before founding Gold Royalty Corp, I ran Gold Corp, which we merged with Newmont back in 2019 to create the world's biggest producing gold company. And before that, I ran Hudbay Minerals on the copper side, and also was the CFO of Agnico Eagle, which is the third biggest producing gold company in the world currently. So it brought in some experience on the operating and mine development side, over 30 years of doing that. And I think it's instructive as we go through the business model that I've switched from building and operating mines to actually running a royalty company and providing capital to the developers and producers and explorers rather than running the mines ourselves. And there's some distinct economic advantages to that model in this point of the cycle, which I'll get into in a little bit more detail over the course of the presentation. But first, we do have some forward-looking information in this presentation, and there is some cautionary language around that. But before I get into the fundamentals of our business, the business model, and also our portfolio in a bit of detail, what I thought I'd do is spend a little bit of time talking about the gold price at the point that we are in the cycle. And I think it's really important when we're discussing that to have some historical perspective. If you look at gold over a 50-year horizon, and the reason we picked this horizon is that really starts at the point where the US government abandoned the gold standard in the early 1970s. And what's happened to the gold price since then? Up to that point, it was fixed at $35 an ounce. And since then, gold price has gone from $35 an ounce to over $2,500 today, an all-time record high, at least in nominal terms. And really, if you look over that 50-year perspective, yes, there's been a lot of volatility in the gold price, but it's really been a one-way trade. Gold is an agnostic indicator of the purchasing power of the underlying currencies of which it trades against. And over that period of time, gold price has gone up exorbitantly. The purchasing power of the US dollar has declined by 96%. And so gold is the one currency and has been for 4 millennia that can't be printed. There's a fixed amount of it up on the Earth's surface. The industry adds a very minute quantity to the supply every year, and that's constrained by capital and political risk and whatnot. So there really isn't the elasticity of supply to price you might expect as the gold price goes up, whereas there really is no limit to the amount of paper currency introduced into the system. And at various points over the last 50 years, we've seen massive expansions of money supply, particularly since the great financial crisis in 2008. And that's continued unabated. Gold is also an agnostic indicator of really where inflation is. It's not, I would say the headline numbers of inflation vastly understate the reality on the ground. We believe inflation, in fact, is 15 to 20%, not the 2 to 3% the headline numbers might indicate, because those headline numbers tend to exclude all the important elements that we need, like food, fuel, and shelter, which are still going up at a double-digit clip. And gold is reflecting that. And gold is reflecting also the fact that there is no opportunity cost owning physical gold right now, because interest rates, even though they have gone up nominally recently, are still at historic lows, particularly when you look at it on a real basis. When you take inflation out, real interest rates, we believe, are deeply into negative territory. And as the Federal Reserve pivots over the coming months and years on nominal interest rates, those real interest rates will continue to decline deeper and deeper into negative territory. So owning a treasury bill actually sees your purchasing power erode, because the interest rate on those treasury bills simply does not cover the rate of inflation. And that's why gold has done exceedingly well at this point of the cycle, and we think is poised to do much better going forward, because we think interest rates are going to continue to decline deeper and deeper into negative territory. And the reason that is because absolute and relative debt levels have never been higher. Global debt to GDP today is 350%. In the last big inflation cycle in the 1970s, it was only 100%. So as Paul Volcker assumed the reins at the Federal Reserve in the late 1970s, he had the latitude to tackle inflation by bringing interest rates up, because he didn't have to worry about bankrupting his government. Jerome Powell does not have that kind of latitude. If he raises interest rates to a sufficient level to tackle inflation, he will bankrupt the US government. Debt service today in the US is $1 trillion per year. That's one of the very $7 of tax revenue generated. And that's doubled in the last 18 months, and is poised to double again in the next 18 months, regardless of what the Federal Reserve does with nominal rates, because of the reset of lower yielding treasuries from the last big financing cycle that the Federal Reserve went through. So we're going to see debt service double again to about $2 trillion a year. That's just simply not sustainable. The only option the Federal Reserves and government have, and central banks globally, frankly, is to inflate the debt away. So they want inflation. They're going to lower interest rates, we think, prematurely, and that will result in a punitive inflationary cycle, which is very, very good for the gold price, not great for our economy. And I should add that when you look at gold prices on a real basis, we're still not at the all-time high. If you look at the gold price back in the early 1980s and inflation adjusts that to $2024, that would be about $2,800 an ounce. So we're still not at the all-time high on a real basis. And we think, given the amount of debt that we're having to deal with on a societal basis, we're poised to see gold prices go up much, much higher than we saw in the last big inflation cycle in the 1970s, for all the reasons I mentioned earlier on. And so I guess the question you might ask yourself is, you're looking at gold equities and you're asking yourself, well, why haven't they performed? It's a good question, and I'll dig into that in a little bit. But if you look at how the gold equities and the gold price have performed after major corrections in the equity markets, actually, we've seen the baby get thrown out with the bathwater initially, whether it's the tech crash in 2000, the great financial crisis in 2008, and most recently the pandemic. We saw a massive sell-off of all equities, including gold equities. But then after that, we've seen, as monetary policies expanded and interest rates have gone down, we've seen actually the commodity and the gold equities vastly outperform the general equity market. And we think we're poised to have that kind of reaction now. What's kept, we think, general equity investors out of the gold market up to this point is producer performance has not been the best in the face of inflation. And the reason that is because mines are not immune from cost inflation that we're seeing in the general economy. So we've seen input costs escalate, and as a result, you've seen significant underperformance of the equities to the commodity. And if you look over a long period of time, the royalty companies are poised to outperform. And the reason they are is because of the nature of the business model. Whereas mining companies have to face declining reserves, have to face cost inflation at the mine site, whether it's capital or operating costs. When you own a royalty, you own a piece of the top line of a mine. And we have over 240 royalties. Virtually all of them are top line royalties. So that completely insulates us from the inflation at the mine site. It doesn't matter what happens to the input costs. We get paid first before anybody else. We get a percentage of the gross revenue from the mine site and protect it from cost inflation. And not only that, as a royalty company, we had exposure to the exploration upside of our operating partners. So we have over 240 royalties with 75, 80 operating partners roughly. And as those operating partners invest in exploration in the ground, we get the benefit of that upside, but we don't have to pay for the exploration. So if all of our royalties, 240 plus royalties, are completely bought and paid for, we don't have capital calls, we don't have cost inflation, we have a high margin business that completely insulates you from inflation and provides you optimum leverage to the gold price and leverage to the underlying exploration that our operating partners are conducting on the properties that we have royalties on without having to pay for it. So it really is the best of both worlds. And so when you look over a long period of time, royalty companies tend to significantly outperform the producers. In fact, the producers actually underperform the commodity. They don't provide you the leverage that you would expect to the gold price as their margins expand, because their margins haven't historically expanded because they have not been immune from cost inflation. And so we do think gold companies are poised to outperform. They've underperformed the commodity. We think there's going to be a reactionary trade at some point as general equity investors buy into the conviction of the gold price, but we think you're going to get the best leverage in a royalty company. And that's why after 30 plus years of building and operating mines, and I've actually been involved in the construction of 15 both copper and gold mines in my career, I've decided to become a financier of mine development so that I can get that exposure to the gold price, exposure to the exploration upside without having worried about cost inflation. The other big overhang on producers is declining reserves. And we've seen, because of the lack of capital markets access for the explorers and developers over the course of the last dozen years, we've seen reserves decline by about 40% in the ground among the major producers in the gold industry. So they're facing not only cost inflation, but declining reserves. And that's really created a bit of an overhang in their stock. So again, we think the best leverage is in the royalty and streaming companies, again, that provide that top line exposure while protecting you from cost inflation and also giving you exposure to exploration upside.
Hey,
The
David,
next slide.
sorry,
Go ahead. I'll pause if you want to ask questions, Jim. Thank you.
There's a question that came in, and maybe now's a good time to do it. So I think you sort of answered this as part of your conversation earlier, but do you think gold is over, under, or fairly valued currently? And maybe to add to that, if it's under, where do you see it going, or where should it be fairly valued?
Yeah, look, I think it's reflective of an expansionary monetary policy right now. I think that's what it is, an accurate and agnostic barometer of. And in spite of the fact that nominal rates went up recently over the last couple of years to tackle headline inflation numbers that approach 8 or 9%, money supply is still expanding. Interest rates are still diving deeper and deeper into negative territory. And so I think really the limit is on gold is going to be when central banks find conviction on money supply, and in fact start to contract money supply as they did in the 70s and 80s under Paul Volcker. I don't see any tendency to want to do that, given the exorbitant amount of debt that major governments in the Western world have strapped on. And not only at the government level, but at the corporate individual level as well. So when I say there's 350% debt to GDP globally versus 100% last big inflation cycle, I'm looking at that holistically, looking at across the broad spectrum of government, individuals, and corporations. So we are an indebted society in the Western world. And the only way to deal with that debt, the fiscally responsible way to deal with that debt, is to inflate it away. There is no way to raise taxes to sufficient level to service that debt, let alone pay it back. So really, I don't see a limit to the gold price. As long as money supply continues to expand, it degrades the purchasing power of the underlying currency, and the gold price is just a barometer of that.
Terrific. Thank you. I'll let you continue on.
Okay, thanks, Jim. So just we'll go to the next slide here, Peter, and what I'll do is talk a little bit about our growth story and the story of our company. We were founded actually privately in August of 2020, and Peter was one of our first employees, probably employee 1B. And we founded it with initially 18 royalties on the underlying development stage assets of our former parent company, Gold Mining Inc., which is in itself a publicly listed company. We were spun out of Gold Mining Inc. with royalties in each and every one of the development stage assets, which collectively had over 30 million ounces of gold equivalent. And we IPO'd the company on that basis. And then, having garnered a very attractive currency and valuation on our IPO, we raised $90 million, had a post-money valuation of $200 million on a collection of well-endowed assets, but none of them producing cash flow. But we recognized we had strong relative currency and used that currency to start to consolidate and roll up some of our peer companies, including Golden Valley, Abitibi Royalties, and Ely Gold Royalties, some of whom you may know if you've invested in the sector previously. That allowed us to add about 150 plus royalties to complement the 18 royalties we had in our inauguration in our IPO. And then over the course of the last several years, we've been systematically adding royalties through a variety of means. We've done it, as I said, through rolling up. When we had the currency to do so, we were quite aggressive in rolling up our peers and growing quite quickly. But we've also done project financings where we've helped developers, explorers, and operators get the capital they need to build, operate, and expand their mines. We've acquired royalties from third parties, prospectors, for example, who are looking to crystallize the value of the royalties they created through their staking efforts. And that's allowed us to bring in some very attractive royalties, some of which are cash flowing currently. And what we also do is generate royalties organically. And the way we do that is we have a small team in Nevada and also Quebec and Ontario, where the vast majority of our royalties are. And what they do is stake exploration claims around existing mines and deposits, wait for the neighbors to knock on the doors and say they need our properties because or deposits do not understand man-made boundaries. So quite often they trend across property boundaries. And then we vend the properties to the operators and developers and take a royalty back in return. And quite often, in addition to getting a free royalty on those properties, we get option payments. And that's actually become a meaningful part of our revenue profile. Not only do we have royalty revenue, but we get option revenue on the properties that we stake out and farm out to the developers and explorers. So it's become a profit center for us. Over 60 of our royalties within our 240 plus royalty portfolio have been generated organically, effectively for free. And again, generating revenue in addition to that. So it's become a profit center, not only an opportunity for us to generate royalties for free. So we're able to toggle from one growth platform to the other. And I think that's unique among the players in the space in that we're able to do all of them quite well. And I think that speaks to the seniority of our management and board, which collectively have over 400 years of industry experience. So there are a lot of people around the boardroom table that look like me in terms of the experience level, bring a similar skill set, but complementary skills that allows us to grow through multiple platforms. And when our currency is weak, as it currently is now, and I'll be the first to say that we're significantly undervalued, and we don't have the currency to do M&A in this environment, we have to find other means of growth that are cost effective and return effective. And the royalty generation model has been a very fruitful source for us for free royalties, but also generating revenue to complement the royalty revenue that we generate from our existing cash flowing royalties. So we've grown from 18 royalties to over 240 royalties through all of those platforms. And we've seen about a five-fold increase in the underlying net asset value of our business. Our share count has not gone up nearly as much, about threefold. And so we have grown the net asset value per share of our business systematically through each of those growth platforms that I talked about a little earlier on. And I think that's the key to our business model is we focus on accretive deals, whether it's generating royalties organically, acquiring royalties through project financing or third-party royalty acquisition. And when we have the currency to do so, when we have a multiple advantage, using that currency to grow through M&A. We haven't done that since 2021, the M&A part of our platform, simply because the currency has not been there. And so we've had to be disciplined and find other means for accretive growth that I talked about in the course of the presentation. Peter, the next slide, please. So where do we stand in the global royalty environment? And this is meant to give you not an exhaustive list, but a fairly a broad spectrum of royalty companies in the sector. And there are two distinct categories as we see it. There are the category killers, the mega caps within the space, Wheaton, Franco, and Royal Gold, that are trading at very attractive multiples, 2 to 3 times price to net asset value. And that's reflective of their significant scale. They're tens of billions of dollars of market cap, and that they have significant diversity in the portfolio. They have great cash flow. They pay dividends. These are well-run companies by individuals I know in the space, and I have great admiration for. And they've earned that premium multiple as a result of being first movers in the sector. They're the oldest companies in the sector, but also they've created significant scale over time and been very disciplined in terms of their allocation of capital. And then we have a collection of what I would characterize as small cap. In the context of the global equity market, these are sub $4 billion, $3 billion market cap companies. They have nearly the scale and diversification of the large cap players in the space. And so as a result, you see a very significant disparity in the multiple between the big guys and the small guys. What we think is missing in the sector is a mid-tier champion. And a mid-tier champion has some appeal, and it's always been our corporate vision to create that mid-tier champion of $5 billion plus market cap with significant diversification in the portfolio that is big enough to matter institutionally, but still small enough to grow. And I think that's what's absent in the royalty sector. And if you look at the producer universe, it was broadly similar back in the 1990s when I was at Agnico Eagle in the late 1990s. I spent 12 years there as CFO. But in 1998, the producer universe looked a lot like this. There was Barrick and Newmont that were the category killers in the space. And then there was everybody else were very, very small cap. There were no mid-tier producers in the gold universe. And Agnico Eagle, over the course of 12 years that I was there as CFO, became a mid-tier, really pioneered the mid-tier in the sector and became a 1 million ounce a year producer, where Barrick and Newmont were struggling to sustain 5 to 6 million ounces of production. By the time Agnico achieved that mid-tier status, it had by far the best multiple in the space, far superior to the seniors in the sector, and to this day still does, because it carved out and really created that mid-tier identity. We see the same type of opportunity in the royalty space, where we think we can get a better multiple than the seniors if we can find that Goldilocks sweet spot in the middle, where you're big enough to be relevant, but still small enough to grow meaningfully. And that's the challenge that Franco, Wheaton, and Royal faces. With their absolute scale, it's virtually impossible for them to grow. We did a $50 million royalty acquisition recently on the zinc silver mine in Bosnia, where we have a copper stream. That $50 million acquisition, to move the needle similarly for Franco-Nevada, they would have to do a $5 billion acquisition. Frankly, there are no royalty and streams available of that scale. So the challenge for the big guys in the space is a lack of growth, a lack of the ability to move the needle with any individual royalty acquisition. So again, achieving that mid-tier status creates that attractiveness of growth and scale, which we think investors are looking for. So we think inevitably there is going to be consolidation within the sector. I can't predict the sequence of it and who will be the survivors, but we think these smaller players inevitably will start to merge, as they did in 2021 when we had a stronger tape for gold equities. But we think as generalist investors start to refocus on the gold space and we start to see multiples reinflate, we think we're going to see consolidation in the sector to create that mid-tier champion, because the re-rate potential, we think, is immense. Even in absence of that, we think the re-rate potential within our portfolio is immense. We're trading at about, on a consensus basis, 0.5 times NAV, but we have by far the best growth profile in the sector, which is the most attractive assets in the best jurisdictions, we believe, in the gold universe.
Hey, David, if I can interrupt you again.
Of course.
So question that came in, are you more nimble as a result of your size? And then part two of that is, would you be competing against any of the big guys for existing royalties?
Yeah, no, it's an excellent question. We are nimble. I mean, we're a collection of 8 full-time equivalent employees. You're looking at almost half of the company here on the phone. And so we're able to make decisions very, very quickly, a small and nimble board, and a sophisticated board. As I said, many of the board members that we have been in the business for a long time. I'll give you a couple of examples. Warren Gilman, who runs Queen's Road Capital out of Hong Kong. I've known Warren for over 35 years, and former Canadian, and has been investing in the space for a long period of time. he's not only able to make decisions quickly at our board, but he also puts capital to work with the company, and he has on a strategic basis. Alan Hare, 35 plus years of experience in the business, was my chief operating officer at Hudbay, was my successor at Hudbay as CEO, mineral process engineer, brings a wealth of technical experience, mine building experience, and so helps us on our diligence exercises on the opportunities we look at. So we are able to make decisions very quickly, very nimbly, and we do due diligence as a result of that on a very efficient basis in order to make acquisition decisions. And yes, we do run into the big guys in the space, frankly. From time to time, the big guys reach down and do small deals, which is a bit frustrating because it really does nothing for them. It's a rounding error, but it does happen, and they have a much lower cost of capital. And I have to say that as a result, we do from time to time participate in competitive processes. And I can tell you in every competitive process we participated in, we failed. We have not been able to outbid the big guys. We have to be disciplined because we have a higher cost of capital. And so we have to find other ways to grow. And the ways we find to grow, and this is true for every major acquisition we made, is we've leveraged a relationship that somebody within our board of management have. And when you have 400 years of industry experience, and many of us have run bulge bracket companies, we have access to everybody in the industry. And so everything we've acquired on a bilateral basis because we had exclusive access to an opportunity before our competitors were aware of them. Otherwise, we simply can't win. And we've looked at over 300 opportunities since our IPO, and we've actually executed on about 11. So we have a very heavy screen, and we fail on a lot more things than we actually acquire because there's always somebody with a lower cost of capital willing to pay a bit more. And as a result, we have to be disciplined, and we have to look at a lot of things.
Terrific. Follow-up question to that that came in. What is the opportunity within the royalty complex of big guys buying smaller companies like yourself?
Well, it has happened, in fact, and since our IPO, and there was no M&A in the royalty space for quite a few years before we launched our company, but because we had such a successful IPO and garnered such an attractive valuation, we immediately started using our currency and did 3 acquisitions in the course of 2021, corporate acquisitions, mergers of equals. And that actually hastened consolidation among our peers. And we've seen 10 royalty companies disappear over the course of 2021 and 2022. The guns have gone quiet since then, just because we've seen an erosion of multiples in the space. But we think, again, as the general equity markets start to turn their sights on gold equities and royalty companies in particular, we do think that consolidation is inevitable. It certainly happened in the producer universe to a great degree because of the factors that I mentioned earlier on. We've seen a 40% decline in reserves among the producers since 2012. And as a result, because of the lack of discovery among the juniors who have not had access to capital, we've actually seen the big guys merge with each other. We've seen a number of mega mergers in the space, and we think that dynamic will continue for the foreseeable future because of the lack of discovery by the juniors who have not had access to capital. So I think you're going to see a lot of consolidation in the gold sector among the producers and the royalty players over the course of the next couple of years to create that scale in an industry that's frankly shrinking.
Yep, fair enough.
David, to build on that and speaking to the opportunity in the royalty and streaming sector, I think this slide also highlights it well on the firm-specific opportunity at Gold Royalty as well. There's obviously a correlation with scale, but we've also seen a correlation of cash flow and non-cash flowing entities. And at Gold Royalty, we see an organic re-rating as something that is on the near-term horizon as our portfolio really matures in the coming quarters and cash flow comes online at 0.5 times net asset value where we sit today, just re-rating back in line with smaller cap peers towards 1 times net asset value as our free cash flow comes online in 2025 is something that's more of a firm-specific opportunity. But Dave, that might dovetail well into as we move forward.
Jim, sorry, was there another question you were going to ask?
There's another question, and I'll ask it, and you can tell me if you want to postpone it or answer it now.
Sure.
So the question is, what's the average payback time you target when making your investment and the average debt load you maintain?
Sorry, I missed the first part. The average, I heard the debt load part, the average.
The average payback time you target when you make an investment and then the average debt load that you maintain.
Yeah, Peter, I'll hand that off to you, and then we'll get into your part of the presentation shortly thereafter. But go ahead.
Yeah, sure. So with regards to return metrics, we're typically targeting on a cash flowing opportunity a rate of return greater than 10% on a base case consensus commodity prices, rather than pinning something to a specific payback, given the variability in mine lives on these finite life assets. With regards to total debt load, again, financing of any opportunity would be dependent on how long dated or what the cash flow profile of that opportunity is. At a corporate level, we look to be very conservative from a capital structure standpoint, keep our long-term or fixed debt to a minimum. Currently, we have no long-term secured debt. We do have a revolving credit facility with the Bank of Montreal and National Bank, but that's flexible and not fixed in our capital structure.
And this is a pivotal year for us. For the first time, and remember, we are a startup, only a little over 3 years old. We're actually in a position to generate free cash flow this year as a number of our development stage assets come into production. And so we've seen a very significant jump in our revenue this year. And as a result, we are free cash flow positive and likely to be earnings positive, book earnings positive in the second half of the year. With that, what I'd like to do is hand it off to Peter. He'll talk through some of our growth in a bit more detail, but also talk about some of the more significant assets within our portfolio.
Yeah, thanks, Dave. So building on what Dave just mentioned, 2024 being a pivotal year, especially the second half year, as some of our key assets ramp up and achieve commercial production towards the end of 2024. And looking ahead to 2025, we'd expect to see further growth as we benefit from a full year of production on those assets. The step change we saw from 2023, 160% growth this year in revenue, is really driven by those recent acquisitions since 2021. We achieved critical mass, we achieved a large portfolio of exploration and development stage assets, but we've had a very specific focus on acquiring higher quality near-term and cash flowing assets over the last 12 months, and that's really delivered the growth you see here going from 23 to 24. Looking ahead and speaking to some of the acquisitions in more detail, you can see we're approaching close to $40 million in revenue by the end of the decade at consensus commodity prices. And that's really driven by 3 of the acquisitions you see on this slide. Our most recent acquisition, as David mentioned, the copper stream over the Vera silver project in Bosnia, very high quality, low cost silver mine. End of last year, we acquired a royalty over the Borborema project in Brazil. That's providing some pre-production payments, but is on track for commercial production in early 2025, so fueling further growth next year. And we also acquired a royalty over the Cozamin mine in Mexico in the middle of last year. This is a high-grade, long-life mine that's had tremendous exploration success and a good track record. What's important to note as this revenue profile crystallizes over the coming years, the profile on the right of the screen, is that this is first based on consensus commodity prices. It doesn't reflect any of the potential gold price upside that David spoke to at the beginning of the presentation. And 2, Gold Royalty has a fixed cost structure. We have very low overheads, and as this revenue is delivered, we don't expect to see any increases in our operating costs. So each incremental dollar of revenue growth will translate into growth in our cash flow profile. This will give us the bandwidth to evaluate potential shareholder distributions in the future. But I note, as we sit today, we are ultimately a growth company, and that would be something to visit as this cash flow profile really matures. Given this track record of acquisitions, the pedigree of the team, we've been able to attract some of the leading financiers in the resource sector to back the company. Our largest shareholders currently are Gold Mining Inc., the company that we were spun out of in 2021. And our second largest shareholder is Nevada Gold Mines. This is a joint venture between Barrick and Newmont, the 2 largest gold mining companies in the world, and they're our second largest strategic shareholder, really backing the long-term vision of the company. Beyond that, we have resource sectors specialists such as Queens Road Capital, led by Warren Gilman, as David mentioned, Taurus Royalty Fund, a royalty-specific fund where we have a strategic cooperation agreement, expanding our abilities to source new opportunities and increases the capacity we have to invest in new assets. They will co-invest with us on new opportunities, which allows us to hunt for bigger, higher quality royalties relative to our size and relative to our smaller cap peers. Beyond that, you can see the list here, other well-regarded resource specialists and investors that are backing Gold Royalty. Brief snapshot of the capital structure, strong trading liquidity on the NYSE, trading just shy or $1.6 million over the past 3 months. Share price at a suppressed valuation in our view relative to the underlying net asset value, and a relatively simple capital structure. Coming back to that question on debt, we have 25 drawn on our credit facility, and we do have 40 million in convertible debentures held through Queens Road Capital and Taurus. So getting back to the portfolio, I spoke to those recent acquisitions really supplementing the long-term growth of the company. But with 240 assets, I could wax poetic on all of the catalysts across the portfolio, but it is those core cash flowing and development stage assets that drive the majority of value in the business. Currently 7 cash flowing assets, another dozen or so at various stages of development. And this is where the true value of the company is easily derived. You can build out a cash flow model, you can take the present value of those assets and understand what the outlook and what the future cash flow of the company is likely to be. Beyond that, and an area where we don't see any value truly being attributed to the company currently, is the optionality inherent in our portfolio of the 200 plus advanced exploration and exploration stage royalties that we hold. And importantly, with these earlier stage assets, they have no holding costs. There's immense underlying resources and significant exploration investment being put into all of these early and advanced exploration stage assets. And we don't need all 200 plus exploration assets to ultimately become mines. There's no cost to them. And a lot of them we created for free. If they become mines, that's when the rate of returns could potentially be infinite on any one of those, delivering future cash flows in the future. Some more holistic metrics on the portfolio before I highlight a few individual assets. I note the quality of operating partner that we're partnered with. We do have 80 plus operating partners, but our cornerstone assets are being driven forward by the likes of Newmont, Barrick, Agnico Eagle, 3 of the largest gold mining companies in the world. This gives them the expertise to advance these assets, but importantly in this market, these are very well capitalized companies that have the balance sheets to deliver on the development timelines for these projects. I'd also highlight the jurisdictional exposure of the portfolio. Over 80% of our portfolio on a net asset value basis is anchored in Quebec, Ontario, Nevada, 3 of the best mining jurisdictions in the world, anchored in Canada and the USA, which gives us a very low geopolitical risk profile relative to our peers. And then finally, amongst these assets, we are over 80% gold exposure, and with the remaining balance being copper through the Varus and Cozamin mine, and a very small portion of silver within the portfolio, but a predominantly gold story. And
Peter,
as I mentioned with the...
Can I interrupt you for a quick second? And I think this may go back to page 10, where you're talking about sort of the corporate structure. One, is there analyst coverage on the company? And part 2 of that is what would be the 12-month price target consensus for the analysts?
The 12-month price target for the stock is $3.30, I believe. That's the average of the 6 analysts that cover us. Yeah.
Perfect. And then
any analysts that covers Jim are Raymond James, BMO, Scotia, AC Wainwright,
Haywood and National Bank.
Thank you.
Terrific. And if maybe post today's call, we can I can send that out to people if you can forward those to me.
Yes, absolutely.
Great. Sorry to interrupt. I'll let you continue.
No, all good. I was building on the overview of the portfolio and speaking to the exploration stage assets that we have. With 240, there's always work. There's always new news coming out across all those assets. But a way we like to aggregate those earlier stage projects and quantify how much work is being done across the portfolio is looking at the exploration plans, the exploration investment that's being put into the ground, which again benefits us as a royalty holder, but has no associated costs. Over the last 4 years, we've seen over 202 million meters of drilling, over $200 million a year in expenditure being put into the underlying portfolio at no cost to Gold Royalty. Now, this doesn't result in immediate enhancement in our cash flow, doesn't even potentially result in an immediate growth in underlying resources, but that drilling that's being conducted today or the past few years ultimately leads to that resource and reserve growth in the coming years, and that leads to de-risking these assets, moving them closer to production, and improving our growth profile in 5, 10, 15 years down the road. But that's credit that we won't get in the market today.
Okay. Quick question on this slide too.
Yep.
What do you think leads to the decrease in 2024?
It's ultimately access to capital. A lot of, beyond those larger operating partners we do have lots of smaller operating partners as well, or exploration stage companies that have not had access to capital. They haven't been able to invest the same amount of money in the ground. They've had to tighten the purse strings, be much more disciplined, focus on lower cost ways of moving these projects forwards. And as a result, you've seen an increase in exploration spend and an increase in drilling across our portfolio. And that's not something that's specific to Gold Royalty. That's a phenomenon that is widespread across the industry.
Sure. Okay. Thank you.
So beyond these earlier stage or just the broad exploration investment across the portfolio, the truly exciting catalysts are the near term cash flowing assets or already cash flowing assets within our portfolio. And as we sit today, we have major catalysts quarter over quarter on these key development stage assets. As Jim mentioned at the beginning of the presentation, our anchor asset is our 3% NSR over the Odyssey underground mine. The largest gold mine in Canada will be the largest underground gold mine once fully ramped up. Our 3% NSR over the underground is really ramping up towards 2028 as Canadian Malartic and Odyssey sits today, predominantly an open pit mine, but shifting over the coming years towards 2028 when it becomes a fully underground mine. They did have initial underground production in early 2023, and their development rates and mining rates at the Odyssey mine have been exceeding Agnico Eagle, the operator's targets. So we're quite optimistic on the potential for increased underground production between now and 2028, this transition period, through areas like the internal zones, which Agnico Eagle has highlighted as really supplementing the existing mine plan. A few key areas of upside at Odyssey. They have a fill the mill strategy. As they shift from open pit to underground, nearly 2/3 of the mill capacity will be unused. So a lot of the neighboring projects or existing resource at Odyssey could fill the mill and massively increase annual production and extend that mine life. And a small portion of the current mineral resource, only about half the current underlying mineral resource at Canadian Malartic, is in the current mine plan. So the opportunity to increase resource conversion is a significant area of upside at Odyssey for our royalty. Moving to Varus, our most recent acquisition, 100% copper stream. This will be a meaningful driver of our near-term revenue growth in 2024 and 2025. They're ramping up to nameplate capacity by the end of this year. So we're quite excited for the team to deliver there and achieving a full year of production in 2025. Their most recent update, Adriatic outlined that they're evaluating studies to nearly increase annual production by 50%, looking at a scenario of a 1.3 million ton per annum plant throughput rate from the 800,000 ton plant throughput rate that they currently have in their mine plan. This would be, again, a tremendous upside scenario that would benefit Gold Royalty without any of the associated investment into that increased throughput. Penultimate asset I'll highlight is the Côté Gold Project. This asset achieved commercial production earlier in August after achieving first gold pour in March of this year. This will be one of the largest gold mines in Canada, and our 0.75% NSR covers the high grade near surface phase one of the pit. So we're expecting to see initial production early on in the mine life here from Côté. What I would highlight with Côté, Varus, and Odyssey is these are not only fueling our future growth over the next coming quarters and ramping up towards 2028, but they're all multi-decade mine lives. Odyssey, Varus, Côté on existing reserves alone have 18 years ahead of them. With resource conversion, you could see these mines extending well beyond to 20 to 30 years of mine life, which is something in a higher interest rate environment we don't get full credit for, but really have tremendous value given their longevity. And finally, I'd highlight Borborema, another recent acquisition, an asset that is on track to enter production in early 2025. And in their most recent update, they outlined that they are evaluating ways to move a road that's near their project, which would increase their reserves by 1.3 million ounces from the current 700,000 ounces there. So a massive increase in underlying reserves. And again, that upside benefiting us for no cost. So quarter over quarter, Varus, Côté, Borborema, all supplementing our cash flow profile in the very near term.
Quick questions, if I can interrupt again, Peter.
Yep.
So one, you talked about gold, or David talked about gold in the beginning, but not so much on copper. What are the thoughts, expectations for copper moving forward?
Yeah, no, I'm happy to touch on that. As I said, I've spent an equal amount of my career building copper mines as I have gold mines, and I'm a strong believer in the fundamentals there. It's both a demand and supply story for the positive, in that demand is burgeoning because of the electrification of our economy, decarbonization. There's no more important battery metal, in my view, than copper. So whether it's electrification of vehicles, expansion of electrical grids to support those vehicles, copper is a hugely intensive used metal in electrification and decarbonization of our global economy. So we think demand is going to go up quite significantly over time as we try to achieve our decarbonization objectives globally as a society. From a supply standpoint, supply has never been more constrained. But because of the dynamics I talked about earlier on, the lack of capital markets access for the explorers in the mining business, and that's just not true for gold producers, but it's true for copper producers as well. There's been a dearth of discoveries in the space, and certainly a lack of commitment of capital to significant mine development. There are no major copper projects in development currently. There are a number that have come into production recently, but there was also one that was taken offline recently, the 10th biggest producer of copper in the world, which is the Cobre Panama project in Panama, which was taken offline by the Panamanian government. So the supply squeeze is immense. And the fact that there is a lack of new capital being allocated to either exploration development in the copper space, and I would say this is true for the broader metal spectrum as well, is that we're not near incentive prices for key metals, whether it's gold or copper, or for that matter, zinc or nickel and whatnot, because we haven't seen any major mine construction underway. That means that the market is demanding much higher metal prices in order to allocate significant capital because the development risk is perceived as high. So in other words, investors are looking for significant risk premium in the rates of return. So they're demanding much higher metal prices before any significant capital is allocated. So I do think there's going to be a significant supply squeeze on copper. And my belief is copper needs to be 2 to 3 times higher than what it is now in terms of price before we actually start to see significant capital committed to new projects to address the supply shortage.
Awesome. Thank you. Super informative. So the next question then is, can you remind us how you acquired the NSR and Odyssey, given its size or potential size?
Well, it goes back to, if we go back to the roots of it, it goes back to our generation model. We did acquire a company called Golden Valley back in 2021 that owned the 3% NSR on Odyssey. So it was through corporate consolidation. But how that royalty originated is very instructive in that Glenn Mullen, who was the CEO of Golden Valley at the time, actually staked the original exploration claims and then vended those on to Osisko Mining, which built the project and then ultimately got taken over by Agnico Eagle. So it was that generative platform that we talked about earlier on, and we retain rights over any of Glenn's staking activities in Quebec through his existing vehicles. So we still have that generative element in Quebec, and as a result, we'll continue, we hope, to generate royalties like this in what's one of the most prolific gold districts in the world.
Perfect. Thank you. No more questions currently. I guess maybe back to Peter to continue on.
Well, I'll pass it back to Dave, and we can open up if there's.
We'll wrap it up. I mean, Peter hits some really attractive assets in the portfolio. He didn't even touch on Ren, which is actually the underground extension of the biggest producing gold mine in North America, Goldstrike, which is operated by Barrick in a joint venture with Newmont. And we have a royalty on the underground extension there, which currently has a resource of about 2 million ounces at over 7 gram a ton material, which is about 7 times the grade they're mining from the open pit, and they're still drilling it from underground. So that's a deposit that's likely to grow and be brought in and integrated into the mine plan where there's existing infrastructure within the next several years. And Barrick and Newmont is working on a pre-feasibility study to that end. So if you look at our portfolio, we have royalties on 3 of the 5 biggest producing gold mines in North America. And over 80% of our royalty portfolio in number and in value is in Nevada, Quebec, and Ontario, which are 3 of the best jurisdictions in the world. And I say that not just subjectively. I look at the Fraser Institute, which is an economic think tank here in Canada that rates jurisdictions globally for mining based on mineral potential, political risk, and regulatory risk. And perennially, Nevada, Quebec, and Ontario are in the top 5 in the world. Because of the significant mineral potential of these prolific geological districts, but also because of the low political risk and low regulatory risk. And we have significant exposure in those jurisdictions deliberately. And we continue to grow our businesses in those jurisdictions. We have boots on the ground, as I said, to continue to generate royalties right beside producing and development stage assets within those jurisdictions, and doing it for basically through our sweat equity. And as I said, we're able to do that because of the depth and breadth of our management team. Collectively, we're 400 years of industry experience. Again, many people around the boardroom table. The most recent addition is Jackie. Jackie joined us. She was the senior mining analyst at BMO, covered all the bulge bracket companies in the space, and she's our VP of Capital Markets. And now starting to reorient our focus on the investor relations side to institutional investors, which basically are unrepresented within our shareholder base. This has been largely a retail-driven story. It was a retail-driven IPO, and we have not really dived into the traditional institutional shareholders. And Jackie brings that expertise and profile as a senior gold analyst at BMO, and she was a former buy-side portfolio manager and analyst as well. So she brings a wealth of experience, and also happens to be a metallurgical engineer as well. So she brings some technical expertise to the table, which we always welcome as we're doing due diligence on opportunities. So we continue to round out our team and our board with experienced people that bring a wealth of complementary skills in the industry to bear. For a company of this size, that's uncommon. And I think the quality of our portfolio, the scale of the assets, again, is uncommon for a company of our size, which I think really speaks to the re-rate potential we see inherent as we start to crystallize that growth, all of which is bought and paid for. So again, we have no capital calls on any of the assets within our portfolio. If we did nothing else and sit on our hands, these cash flows come in. There are no capital calls. Our G&A costs, as Peter said, are very, very low. We have about $7 million of cash G&A per year. As we achieve and hit stride over the next several years, we're looking at an 80 to 90% margin business, which can only grow as we continue to add cash flowing royalties into the portfolio, and hopefully deliver on some of that optionality in some of the earlier stage royalties, which we think garners no value in the markets currently in this depressed valuation environment for gold equities. So with that, Jim, be happy to take any follow-up questions and leave it to you to wrap up in due course.
Terrific. Wonderful. David, Peter, Jackie, thank you for all of that. So just a reminder for people on the call today, use the navigation pane at the bottom of the screen, click on the Q&A or the chat. We'll get any questions you have answered for you. I do see that we're coming up close to our 1 hour timeline. So I have two questions that I always like to ask at the end, sort of related to each other. But so part one is what keeps you up at night? And part two is sort of the opposite of that, and it's what are you most excited about?
Yeah, well, number one thing that keeps me up at night in the normal course is just deal flow, trying to find deals that continue to grow our business accretively. And that's an exceedingly challenged thing to do. As I said, we've looked at over 300 opportunities since our IPO. We've executed on 11. So, it requires a significant effort across the board within our management and board in order to continue to generate source opportunities and then ultimately execute on them. So that it is a constant preoccupation, but we're quite disciplined, and that's why we have such a heavy screen on the things that we look at. We want to make sure that we do things accretively. The other thing that keeps me up at night is our share price performance, which has been abysmal. And I attribute that to the fact that we have been a growth-oriented stock for a number of years. And now we're actually starting to crystallize that growth. We're hitting our stride, and we hope to see that re-rate. But it's frustrated me. It's the lack of diversification in our shareholder base has frustrated me. That's why we hired Jackie, is to bring that kind of diversity in our portfolio, and hopefully that'll hasten the re-rate that we think we richly deserve, given the quality of our portfolio and the quality of our cash flow growth. And that's what's also the most exciting thing, is that we're finally on the cusp of delivering that growth. And it doesn't require any capital or any attention from us from a management perspective. We own the assets outright. They're bought and paid for. We just have to wait for our capable operating partners to deliver on their growth objectives. And that means significant revenue growth for our shareholders. And the upside from the gold price is completely unmitigated. So if you do believe in the investment case for gold, we have full and unmitigated exposure to that because of the inflation protection inherent in our royalty model.
Excellent. Well, fantastic story. Lots of upside, lots of growth potential coming forward. For everybody on today's call with the questions that came in, I thank you for that. To David, Peter, and Jackie, thank you for the presentation and sharing the story, and your excitement obviously is well received and noted in it. Particularly the fact that you believe you're undervalued and have significant growth potential over the next, short term and long term. We'll make sure to get everybody copies of some of the analyst reports after today's call. And with that, we'll officially wrap it up, and I thank everybody for their time.
Thank you.
Thanks, everybody.